Good afternoon, everyone. Thank you very much for joining us. And some of you may be familiar with Milosh. He did the Healthcare Investment Trust webinar a while back. And we have this concept at Edison called domain expertise, where we try and marry up interest with passions. Milosh, a couple of years ago, told me that he was very interested in the whole digital asset cryptocurrency space. So we've allowed him the freedom to go and research this area. Mike mentioned that there's a series of reports, a five-part, at least five of them published. We got one out a week on the Edison website. You can navigate through the top menu, just go through thematics, and you'll find them. Um, Milosh, let me start off. Establish some foundation. So there's going to be a lot of people familiar with Bitcoin, but probably less familiar with the broader ecosystem. So could you start by just explaining how the digital asset landscape has evolved and what we mean about when we're talking about different types of tokens, exchange tokens, tokens, governance tokens, and security tokens?
Yes, absolutely. I'll probably start by saying that the digital asset landscape has evolved quite significantly since Satoshi Nakamoto published its Bitcoin white paper back in 2008. Probably an important milestone to highlight was the launch of the Ethereum network back in 2015. So I guess the first major smart contract enabled blockchain. We will get into the details later on. And since then, we've seen an explosion of the number of tokens. There are thousands of them currently, I think around 9,000 tracked by CoinMarketCap. And we felt it's important to highlight how these can be segmented, basically. So you can think of the whole landscape as divided into four types of tokens, digital assets. The first one are exchange tokens, which are meant to be a means of exchange. Therefore, they are called exchange tokens, and a store of value, where Bitcoin is the most prominent example. Exchange tokens are not to be confused by utility tokens issued by crypto exchanges, like the BNB token issued by Binance, right? So the largest or one of the largest exchanges. The second group are utility tokens, which provide their holders access to certain on-chain products and services. The third category are governance tokens, which give you the protocol level voting and treasury control rights. Here an example would probably be Uni token, which is the native governance token of the decentralized exchange Uniswap. And then finally, you've got security tokens, which are basically, digital financial instruments. There are two types of security tokens. One group are traditional financial instruments brought on chain. We can think of it as, for instance, tokenized equities or tokenized money market funds. And the second group are native, so on-chain tokens, which provide their holders a certain income stream from on-chain protocols. A good example would probably be the Sushi token, which is the native token of the SushiSwap stock exchange, decentralized exchange, whose holders can directly benefit from the fees generated by the protocol itself.
Okay. And I should have mentioned, I mean, I normally deal with equities, and this is a kind of an alien territory for me. I'm sure for a lot of people, there's going to be a lot of questions, and so happy to sort of field them. We can sort of build up some more sort of foundation level understanding if anyone has. So I'll keep an eye out on the sort of Q&A. We will try and do the sort of chat for about 35 minutes and then sort of open it up to Q&A. You describe Bitcoin as digital gold, but Ethereum and Solana as digital oil. Help us unpack this analogy and explain why these assets have fundamentally different value propositions.
Yes, absolutely. Of course, we are trying to make those comparisons. It's not that I coined these terms.
Yeah.
They are known more broadly in the industry, because we are trying to find kind of a comparison to the traditional world of financial instruments. Let's put it that way.
Yeah.
So Bitcoin obviously evolved from its previous reputation of dodgy internet money into a well-established store of value, hence the digital gold narrative, right? This is because it provides a certain set of unique, well, a kind of a unique value proposition because it's decentralized, it's basically incorruptible, kind of a separate monetary system, which allows you to transfer value across borders. Of course, the narrative of Bitcoin changed over time a little bit because initially it was meant as a kind of a means of day-to-day payment, but because of the limitations of the throughput of the Bitcoin network, roughly 7 transactions per second, which is hardly comparable to, I don't know, Visa or MasterCard.
Yeah.
The narrative has changed over time. So because of these unique characteristics, so that it's tamper-proof, that it's independent from the broader monetary system, central banks, it doesn't require any intermediaries to transact, and because of its scarcity, a well-defined supply model, it evolved into a, well, I think quite broadly recognized store of value, right?
Yeah.
As illustrated by the fact that there are now multiple US listed spot Bitcoin ETFs, right? Now, when we talk about Ethereum and Solana, they are also sort of contenders in the store of value race. They also have their own spot, ETFs. But the utility goes beyond a certain value because of smart contracts, which their blockchains feature, which are programmable contracts. We'll talk about more in a moment, I think. But basically, because of that, their utility goes beyond the store of value as they give people access to certain on-chain services and applications across trading, lending, borrowing, prediction markets, insurance, minting of non-fungible tokens, so collectibles or in-game items, and etc.
Yeah.
Right? So there's a wide variety of applications for smart contract native platforms. And in order to use those applications, in order to run those smart contracts, you need to spend a certain amount of native tokens, be it Ethereum or Solana, right? So this is why we compare it sort of to digital oil, right? Especially for those
Yeah.
blockchains where those tokens which are spent to run those smart contracts are being burned, which means removed from circulation, right? So it
Yeah.
makes them akin to a kind of a commodity.
Okay. And if you read the research, you hear the sort of concept of staking yields, which is mentioned throughout the research. Maybe just explain to people what staking yields are. The Ethereum offering around 3%, Solana 6 to 6.5%. And I, for I mean, I think people are familiar with fixed income instruments, so maybe draw a parallel with fixed income instruments and how they should think of these yields and where they sort of come from.
Yes, absolutely. So I would start probably by distinguishing between the consensus algorithm and the Bitcoin network, which is a proof of work algorithm, and the proof of stake algorithms on the Ethereum and Solana blockchains and many others. A consensus algorithm is basically tells you how new transactions are added to blockchain, right? So
Mhm.
how are they validated basically and added? And how the network is being secured, right?
Yeah.
So in case of proof of work, you have Bitcoin miners who devote their computing power to try to solve a mathematical puzzle, and the Bitcoin miner who does it first receives basically a block reward. In case of proof of stake blockchains like Ethereum and Solana,
Yeah.
you can lock up your digital assets, which are native tokens of those blockchains. You can lock them up as kind of collateral to secure the network, and in exchange, you then receive the so-called staking rewards.
Yeah.
I would probably, rather than thinking of it as rather than drawing a parallel to the fixed income space, I would probably rather compare it to a scrip dividend, because basically you receive rewards in the same native token, right? And also what's important, the staking yield is not fixed. It changes over time. It's different for different blockchains, but it also changes over time for a given blockchain because it's dependent on a a number of factors, be it the proportion of the total supply of tokens being staked. So what's the proportion of all tokens staked at a given time, the
Yeah.
level of network activity, the level of fees, including tips on the network, and so on, right? So it's not set in stone, but it is an interesting distinct feature of these tokens, which basically means that they are, well, yielding assets as
Yeah.
opposed to, Bitcoin in the traditional sense.
Okay. You touched on an earlier talking about smart contracts. And yeah, they seem pretty central to the space. In plain terms, I mean, what are they? And
Mhm.
and why do they matter for investors thinking about digital assets?
Yes, it's probably not so simple, not so easy to explain it in 2 or 3 sentences. But if I will give it a try. Basically, you can think of them as traditional agreements, but which are programmable, which means that the terms of the agreement are embedded within the code on the blockchain.
Yeah.
This means that they can be executed automatically without the involvement of traditional intermediaries, which is one of the advantages of blockchain in general, right? That it eliminates intermediaries. Um, in case of Bitcoin, it's more about validating transactions and making sure that there is one single source of truth in terms of who transacted when and what volume. This is expanded in case of smart contract enabled blockchains, because smart contracts allow you for a wide variety of use cases, right? Because you can program any agreement you want to and use it to create various on-chain applications, basically.
Okay.
So for instance, if you are transacting in a decentralized exchange on the Ethereum network, you don't need a broker, you don't need an intermediary. You can simply use the existing smart contract, run it, and transact.
Okay. And so you can do this directly, or practically how does that work? Do you go onto a platform and execute the contract?
Uh, no, I mean, you can basically use the interface of the decentralized application
Okay.
to run it, right?
Okay.
So it's the space evolved over time, and it's now becoming much more user friendly, right? In
Yeah.
terms of the user interface, right? So you don't have to be a tech expert to actually run those smart contracts, right? Because you have a user friendly front end.
Okay. Um, DeFi, decentralized finance, has attracted 147 billion in total value locked. Give us a quick primer on what DeFi actually does and why it's relevant to the investment thesis.
Mhm. Absolutely. So I've touched upon smart contracts and the various decentralized applications which can be built on top of blockchain because of the fact that developers can use those smart contracts. So DeFi is one example of a set of different services built on chain, on the blockchain.
Mhm.
You can think of it as a global open alternative to traditional finance, so granting all users free access to financial products such as borrowing, lending, trading, insurance as well, payments without the need for traditional intermediaries in a 24/7 setup. Now, is DeFi currently a serious threat to the traditional financial system? Probably not, because it's still a relatively nascent sector, yet to reach mass adoption. But still, the amount of value lock you've just mentioned, right? So the close to 150 billion, because it changes over time, depending also on the prices of tokens. But I think it's still impressive, still shows a certain degree of mass within the industry. Um, Now, so far, most of the demand for DeFi came from crypto native activity around investing and trading in cryptocurrencies and NFTs and the associated fiat on and off ramps. So this benefited lending protocols such as Compound, decentralized exchanges such as Uniswap, as well as stablecoins, both centralized, such as USDC or Tether, um, and both centralized like these two and decentralized like Sky, for instance, right? Stable coins, just as an introduction, are cryptocurrencies or digital assets which are pegged to a traditional, so fiat currency,
Yeah.
most of the time to the US dollar. And that can be used as a means of payment, as collateral across the DeFi ecosystem. It can be deposited, can be lent out. So there are various applications, well, within the DeFi ecosystem for stablecoins.
Okay. And so look, I mean, there is this. I mean, to me, it's a somewhat unique world, the crypto world, and I guess we're trying to demystify a little bit. But there's other ways to get exposure to it. And you've made the sort of case within the series about getting exposure through sort of listed equities. So you've set out that there are listed blockchain equities rather than going to hold direct cryptocurrency holdings. Can you explain to investors who are sort of seeking exposure to digital assets? So if they buy into this idea that, the blockchain, the technology, the removal of middlemen, etc., is something which will grow over time. Can you explain to investors, I guess, who are looking for this exposure, why they should consider equities alongside or instead of holding tokens themselves?
Yes, sure. So first of all, of course, I'm not saying that investors should abandon their investments in digital assets like Bitcoin, Ethereum in favor of blockchain equities
Yeah,
entirely, right? That said, blockchain equities do provide certain distinct advantages over just plain exposure to the underlying asset. Um, Firstly, we need to remember that as much as, of course, the growth in the price of uh, Bitcoin and Ethereum is impressive, um, the link between the commercial success of the underlying blockchain or the on-chain applications is not so straightforward. It's not a relationship similar to the growth in the share price of a regular company, of equities of a regular company with the growth in earnings. Of course, it's also
yeah.
not a smooth path, but you can see a clear path over the long term, right? Um, Here, because in most cases, the network fees don't accrue directly to the holders of the tokens, right? That there's not this direct link, right? So some investors may consider, exposure to blockchain equities as easier to understand, easier to, instruments which are easier to value, right? Because
Hmm.
you can use the standard earnings multiple approach, right? And addressable market and so on.
Okay, okay.
Yes.
The regulatory environment has shifted dramatically, particularly in the US with the Trump administration sort of executive orders and the Genius Act. And you may explain what the Genius Act is. How significant are these changes, and what should investors understand about the current regulatory landscape globally?
Yes, absolutely. Maybe I will not delve too, I mean, deep into each of those regulations, but like the bottom line is that, well, Donald Trump's pro crypto agenda and the appointment of Paul Atkins as this SEC chair made a huge difference.
Yeah,
Some of our webinar participants tracking the space for a couple of years know that the previous SEC chair, Gary Gensler, was clearly a crypto skeptic.
yeah,
And I mean, he basically blocked the introduction of US spot Bitcoin ETS for as long as he could until, well, probably, well, I would say one court basically told him that there are no rational reasons for delaying it further.
yeah,
And the SEC back then was also, in my opinion, ruling mostly by enforcement, which means rather than setting a clear framework for digital asset companies, they used to run legal actions against regulatory actions against certain players who they believe did not comply with existing regulations, right? So all that I think changed quite dramatically over the last 12 months or so. I mean, this is illustrated, for instance, by the Genius Act, which created a clear framework for stablecoin issuers. Um, you have certain executive orders from Donald Trump, including one which basically, well, opens the door for cryptocurrencies in 401k accounts. Of course, the providers themselves also need to take call on this, but basically the regulatory blessing is sort of there. Um, And it's clear that Donald Trump would like US to be global capital for digital assets,
Yeah.
basically. And then you've also seen positive developments on the regulatory side across other jurisdictions, including the MiCA regulation in the EU, new regulations in Hong Kong, Singapore, the UAE, Saudi Arabia, and even in the UK, right? With the recent well, FCA recently opening up retail access to crypto ETNs.
Okay. So basically, in summary, it's becoming a more friendly environment from a regulatory perspective, and they, I guess, the protection or they're not effectively restricting retail from investing in crypto. It was interesting. I think a recent panel, which was of, I guess the audience was really in sort of the sort of 30-year-old sort of age bracket. I think 90% of them own crypto, and it was I was always amazed at just the extent that this is sort of taken off. Um, you talked about Bitcoin miners, so this is, guys who effectively running compute effectively to earn crypto. So Bitcoin miners represent a leverage play on the sort of underlying asset. Walk us through what the sort of key metrics people should be focusing on when evaluating miners. So what makes a good miner, a leading miner effectively? I think your report talks about Mara Holdings versus, I guess, a less good miner.
Yes, absolutely. So maybe just to start, there is a certain analogy between gold miners and gold and
Yeah,
Bitcoin miners to some extent. But what is important is that basically all Bitcoin miners mine from the same deposit, if you
yeah,
can call it that way, because you have
yeah,
a certain clearly set amount of Bitcoin of blockchain rewards in the form of newly minted Bitcoin,
yeah,
basically, which all Bitcoin miners are after, right? They, as I mentioned, they compete to solve a certain mathematical puzzle, right, which requires a lot of computing power. So, I mean, the key competitive advantages of a good miners are first good access to cheap and reliable energy sources and well-structured power supply contracts.
yeah,
Secondly, it's about the computing power that they garnered, right? So, which is expressed as called hash rate. In order to effectively mine Bitcoin, well, you can't just use your home PC anymore, right? These times are
yeah,
over. You need ASICs, so application-specific integrated circuits, which are getting regularly upgraded. You have well, two large global players providing ASICs and coming up with new, more efficient versions all the time. So you need to constantly spend a lot of money on the new gear, so to speak, because you need good access to financing. Probably you also need to be well skilled in terms of optimizing the use of your hardware, proper cooling
hmm
systems, of course, and so on. And then what's also important to check is whether a Bitcoin miner is selling the Bitcoin mines to fund no, corporate purposes, CapEx, or distribution to shareholders, or if the miner is retaining the minted Bitcoins in treasury to
yeah,
benefit from the potential further upside movement in the price, right? So
yeah,
the Mara Holdings, which you've mentioned, is probably one of the largest balance sheet holders of Bitcoin,
yeah.
even
Okay.
though it's not like a pure play Bitcoin treasury company, right? But it still has accumulated one of the largest Bitcoin stacks among listed companies.
Okay. I think I understand the analogy. We are seeing miners pivot towards sort of high performance computing and AI applications. Is this diversification a sign of strength or a sort of concern about the sustainability of pure play mining economics?
Yeah, that's actually a good question. When talking about the sustainability of Bitcoin mining economics, we need to remember what I said earlier is that mm, the future supply of Bitcoin is very well defined in,
Yeah,
in the code, right? So we know exactly how many Bitcoins will be minted after 500,000 transactions, 1 million transactions in a couple of years' time.
Yeah.
After 210,000 blocks, basically, which is roughly the full year, the block reward declines by 50%. So basically, for the same computing power, you get 50% less Bitcoins,
Okay.
right?
Okay.
Which means that in order for the business model to be sustainable for a given miner, either the Bitcoin price needs to double every 4 years, roughly, or you should see a significant increase in transaction fees, because apart from the block rewards, miners also receive transaction fees, which are currently a relatively small proportion of overall revenue. And finally, of course, if you're a Bitcoin miner, you can try to remain competitive, low cost, in order to push some other players out of the market, right? So you
Yeah.
basically gain market share, consolidate the market in order to stay competitive. Now, of course, there may be different outcomes in a couple of years' time. I'm not in a position to forecast the price of Bitcoin. One scenario might be that the share of transaction fee increases, that Bitcoin will be more considered as a kind of a base settlement layer. So a little bit something like a Fedwire in the US, right? With a
Mhm.
high transaction fee per transaction, which will make it more suitable for large volume transactions. But it's purely hypothetical, right? So of
Yeah.
course, we need to keep this in mind when thinking about the Bitcoin mining industry. Now, when talking about AI, of course, it all depends on what's your view on the current spending spree
Yeah.
on computation power to support HPC and AI, basically. Um, uh, if you like it or not, many Bitcoin miners have basically become part of the team. They are sort of natural providers because they have the infrastructure, they have the power contracts, the sites, the cooling equipment, um, and so on. What it does for Bitcoin miners, probably it may reduce business volatility a little bit, because you are not exclusively dependent on the Bitcoin price, and you're not at the
Yeah.
mercy of Bitcoin's volatility. You can have long-term contracts with those HPC AI providers. But then, of course, it's all about how those contracts are structured. What's the unit economics per megawatt? If you have any take or pay clauses or minimal utilization clauses, what's the termination terms? What are the termination terms? What's the um, credit quality of the counterparty, etc. So there are a few moving parts here, I would say.
Okay. And let me just to clarify, people are almost compelled effectively to become more efficient because of the way that the market is structured. And those efficiencies come from either, you're lowering your power cost or improving your compute cost effect or improving your ability to run computation more efficiently. So more powerful machines, I guess. Is that the way to think about it?
Uh, well, yes, sort of. I mean, yes. I mean, it's all about efficiency. It's all about optimizing um, the use of electricity. It's about making sure that also you adjust to the changing electricity price during the day. I would say that you have efficient systems to optimize the use of those. And the ability to maintain your hardware in a proper way, and yes, and you have the balance sheet strength to fund the purchase of new equipment. Now, it's interesting in the sector is that historically the prices of ASICs was correlated with the Bitcoin price. So
Hmm.
probably some of the smarter players who spend a lot of new equipment when during a market downturn, then were able to benefit from better
Yeah.
economics.
Okay. And I mean, it's a bit less of an issue today, but sustainability, it does dwell on investors' minds, and it may come back as an issue. How should we think about that? And in particular, these are, consuming power to create crypto. How do you think about the sort of carbon footprint, and is this a concern?
Well, yes, this has been, of course, an important part of the Bitcoin debate for quite a while. So the carbon footprint and the energy consumption, of course, people like to compare the energy consumption across the Bitcoin network to energy consumption of entire countries,
Yeah.
um, which is of course very catchy, but we can do that because it's relatively easy to approximate the energy consumption across the whole network,
Mhm.
which is not that easy for, let's say, the global financial system, right? No one is
Yeah.
asking how much energy is the global banking system consuming, right?
Yeah.
So that's probably a point worth making. Um, but of course, it's true that under the proof of work algorithm underpinning Bitcoin, um, well, miners basically compete with computing power. But this is the very reason why the Bitcoin network is so secure, because you have so much computing power and hardware securing the network, right? The question is,
Yeah.
of course, if the value add coming from the network justifies the energy consumption,
Yeah.
which of course it's can be debatable. But you can think of other, let's say, sectors consuming energy where you can ask the same question, basically. Still, if investors who are more concerned with the carbon footprints and the energy consumption can at least look for miners which largely fully utilize clean slash renewable energy sources. So
Yeah.
at least the carbon footprint point is tackled. Um, but of course, if someone would like to avoid any exposure to the proof of work um, blockchain, they can always try and focus on business models which focus more on proof of stake blockchain. It's not maybe that easy, but you could theoretically try to do that. And of course, the proof of stake algorithm consumes just a fraction of the
Of the
energy
yeah.
proof of work blockchains consume. This is
Okay.
one of the reasons why Ethereum moved from proof of work to proof of stake.
Okay. So I mean, like I guess I like drawing parallels to other things that we understand. So, like the equities space, there is an infrastructure that supports that. So there's exchanges, brokers, custody providers. Your series covers the same for the sort of crypto space, including ETP issuers. Where do you see the most compelling investment opportunities within the infrastructure layer? What are the competitive dynamics shaping the sector?
Mhm, mhm. Yes, there's now quite variety of companies, listed companies providing infrastructure services,
Hmm.
CB exchanges, prime brokers for institutional investors. You've got also custodians, ETP providers. So there are quite a number of companies you can choose from. Now, when we talk about the competitive, landscape in terms of exchanges, of course, the game is sort of similar to traditional exchanges and brokers like Robinhood. So of course, you need to have a wide range um, uh, of tokens
Yeah.
listed. You need to provide exposure to the right investment universe. Then you of course need to provide a good user experience. You're looking for loyal customers, a growing customer base, low customer acquisition costs, and so on and so on. So all those factors which everyone knows well from the traditional space. Um, Importantly, there are several listed exchanges which are some of the top players in the industry.
Yeah.
Not all of them are listed, but you already have a few of them to choose from. But now beyond that, what's also important is that exchanges have the opportunity to build out their ecosystem into adjacent services, um, which is not the case for traditional exchanges. What is very important to note is because blockchain eliminates intermediaries, you can transact on an exchange without a broker, right?
Yeah.
So you can
Yeah.
open up a Coinbase account. You don't need to have a separate brokerage account. You just have an account at the exchange. Moreover, the exchange basically is the custodian for your crypto. Of course, you can
Yeah.
then transfer the crypto from the exchange into your self-custody wallet, or institutional investors can use third-party custodians to store them. But exchanges like Coinbase, they also offer prime brokerage services to institutional
Yeah.
investors, including custody, including lending, um, and so on. So they have an interesting opportunity to move into adjacent services. Um, they can also like Coinbase, they can also establish their own layer two network sitting on top of Ethereum, for instance, and trying to generate transactional fees from on-chain applications, from payments,
Yeah.
etc. And then they can also pursue the tokenization team, which means that they are expanding the investable universe available at exchanges. So Coinbase even in its strategy, it even says that it's looking to create an everything exchange from traditional cryptocurrencies through tokenized equities, tokenized other real world assets like real estate,
Mhm.
private equity, and even providing exposure to prediction markets and so on. So basically putting
Yeah.
everything under one umbrella. So that's interesting. And then of course you have those other providers I mentioned, like ETP issuers, which are can generate regular fees based on the AUM. Some of them are also doing other things like non-directional trading, because they have some of them um, created a very a very sophisticated infrastructure to provide to be a liquidity provider for their
Yeah.
products. So they also tend to trade on their own books, basically.
Okay. Okay. And look, I mean, there is this ecosystem, and you mentioned some of the sort of players. What happens when, should a JP Morgan or a Goldman suddenly decide that this is a space we want to move into? How should, if you're thinking about investing in, Coinbase or one of the sort of specialists, what's the competitive threat from traditional financial institutions if and should they choose to move into this space?
When we talk about trading in digital assets, I would probably think more about the likes of Robinhood or eToro,
Hmm.
which already offer
Yeah, services. Yeah,
services. I mean, trading in digital assets and tokenized equities, for that
yeah,
matter. So, of course, this is they are a real competition, especially in the retail space, um, uh, which may result in fee compression on the retail side. I would imagine that the well-established crypto exchanges, they probably have a quite deep moat at least deeper moat in terms of institutional investors with all those
yeah,
adjacent services. Um, so that's probably important to mention. Of course, some competition comes from crypto ETPs, but it's worth mentioning that, for instance, Coinbase, if I'm not mistaken, is the custodian and prime broker for BlackRock's spot Bitcoin ETF. So
yeah.
this
Okay,
means that they can still, generate some income on
okay,
back of it.
okay. Let's switch to some of the papers deal with sort of tokenization and payments, and there are some questions coming in, and we'll come back to these. But stable coins have seen explosive growth. I think monthly transaction volumes now exceeding $1 trillion. What's the investment case for Circle Internet Group, and how's their sort of business model work beyond simply issuing USDC? And maybe explain what USDC is as well. Yeah,
Yes, of course, of course. Yes. So stablecoin issuers like Circle Container Group are quite interesting in that, the business model relies on issuing stable coins, right? They basically
yeah,
mint the stable coins. Um, they received traditional money exchange, so US dollars, for instance, right? They are then held in segregated accounts, one to one. For Circle, it's primarily the Circle Reserve Fund,
yeah,
and then they can generate interest income on this on these reserves, which are for Circle they are held in cash and short-term treasuries.
yeah,
Um, in Q3, the average yield Circle generated was 4.15%, if I'm not mistaken.
yeah,
Um, so it's basically a nice model, right? So you issue a stable coin, so a token which is pegged to the US dollar. You collect the traditional money, you put it into a reserve, earn interest on that, right? And just to give you an idea of the size of the business, so Circle's total revenue, including the interest income, which is now the chunk of the revenue, was in Q3 $740 million, right? So this is the
okay,
sheer scale of the business. Now, Circle has also built several services around its stablecoin, including liquidity services, so institutional minting, redemption FX services, payments network. They even launched their own layer one blockchain for payments, FX, and capital markets. So they're trying to start to monetize certain transaction flows and elements of its infrastructure. It's still relatively early stage, but the company believes that this is a high margin and fast growing and scalable part of their business model, which is quite interesting, I think.
okay. And let's touch on the idea of asset tokenization, which firstly, what is it? And then it's described as potentially reshaping financial markets, with I think no less than McKinsey saying that that it's a market that could grow to somewhere between 2 and 4 trillion by 2030. So which listed companies offer best exposure to this theme, and what are the kind of typical catalysts that people should be watching for?
Yes, maybe I will start by providing some broader picture of
Mhm.
the asset tokenization potential. I mean, I think we all understand that there is quite a lot of potential to improve the piping of global financial markets in terms of settlement, use of collateral, etc. It's really pretty outdated, right?
Yeah.
So tokenization is basically a possible answer to this, as it's first of all, it provides easy access for investors to investments, across the globe 24/7. Of course, maybe subject to certain KYC and AML and other whitelisting rules, but
Yeah.
the underlying technology allows you to transact across borders very easily. It facilitates secondary liquidity of assets which are normally considered liquid, like private equity or real estate. It supports fractionalization of assets. It reduces administrative burdens, and also facilitates better composability because if everything is sitting in a common ledger, then of course it's easier to reuse collateral. And it also allows for more flexible and customer-centric custody models where investors have greater control over the assets they hold, right? So there are many different um, benefits of asset tokenization. Now, in terms of how one can get exposure to the theme via listed equities, as I've already mentioned, some of the infrastructure players, they also want to expand into tokenization, or they are already running tokenization projects. So this is one way of doing that. Secondly, there are already a handful of pure play tokenization platforms, which are, maybe small cap companies, some of them early stage, but still something maybe worth considering. And I believe that there will be more companies providing exposure to asset tokenization in due course.
Yeah. Okay. Um, let's let's move on to Bitcoin or digital asset treasury companies. And there were it was it was a little bit of a sort of trend that companies were announcing that they had a treasury strategy, and you'd see the sort of share price rocket effectively for them, but some Aquas companies even. Um, so you've seen a proliferation of this in 2025. I think Strategy Holdings has 640,000 Bitcoins. What are the sort of genuine advantages of getting exposure through a treasury company versus an ETF? And what are the risks investors need to understand?
Mhm. Yeah, so it has been a quite hot theme in recent months. I think the number of crypto treasury companies went up to something like 200, if I'm not
Yeah,
mistaken. Um, Now, let me put it this way. Needs to be a clear rational advantage um, for an investor to wanting to gain exposure to Bitcoin or another cryptocurrency via PLC holding the underlying asset rather than directly,
yeah,
or via ETPs, right? Which are
yeah,
normally low cost, right? Um, for some, for instance, institutional investors, a PLC wrapper may be helpful in terms of overcoming certain mandates, custody or tax limitations.
yeah.
And I guess maybe for some retail investors, it might be also a more convenient way because you can just buy the
Like the
stock on the
shares.
regular
Yeah,
stock exchange and that's it. Um, some may find it attractive that some of them may provide geared exposure to the theme. Although, given the volatility in digital assets, the question is to what extent do you really need a geared exposure to that, right? And you can get it in different ways. Um, a potential advantage of those treasury companies is that they can be more active in terms of the use of those treasuries to generate alpha, first of all. So time, so optimize the timing of additions to their treasuries. They can use certain derivative strategies like covered calls. They can also use those assets for yield generation across the network. So they can
hmm,
stake those assets. They can generate yield across decentralized finance. They can lend them out. They can participate in the network, like via staking, but also running validator nodes or being liquidity providers, like for instance on the Bitcoin Lightning Network, so kind of a layer 2 network on top of Bitcoin. They can use this treasury as collateral to optimize the funding costs. So there are a few ways in which they can provide well, an extra return on top of just a passive investment in the
Yeah.
underlying asset. But what's important to remember is that, I mean, if you invest in an ETP, you have a very low tracking error, right? So you can reasonably expect that it will basically behave like the underlying asset. This is
Yeah.
not necessarily the case for a PLC. It can trade at a discount or premium to NAV, much like
Yeah.
closed-end funds,
Yeah.
basically. So that's one thing. Secondly, of course, you take on the company-specific risks around dilution, around stock overhang. There were a number of crypto treasury companies doing pipes right in the US, and then when those when those are this additional supply is basically admitted to trading, it sometimes resulted in a significant decline in the share price of those companies. Of course, all the risks around debt, governance, and so on. This is you need to take this on board, and you don't have a kind of a bankruptcy remote SPV structure like with ETPs, right? Of course, if a company properly custodies the underlying assets, then in case of bankruptcy, of course, these assets can be used to
Yeah.
repay the debt holders and shareholders to some extent, but it's not segregated accounts, right?
Yeah.
Basically, which is probably important. And then while these companies may have better opportunities to generate yield, the question is whether they will always distribute it to shareholders directly
Yeah.
or use for other corporate purposes, other business lines, etc. So all these things need to be considered, carefully considered when investors look at treasury companies.
Okay. Okay. So look, I mean, it's one of those sessions where I feel that if you're not familiar with it, it's almost like learning a new language, right? And
Absolutely,
you
yes.
you might need a strict stiff drink after it. But I think we've tried our best to start to demystify it to a certain extent in terms of, there is that you have to believe effectively in the store of value and the limitation, etc., in the underlying sort of crypto. There are different ways of then starting to play that, which I think you've started to articulate. And I think the materials you have on the website really go into a good way of explaining those. Before we sort of come on to the sort of questions that are popping up, let's just cover off the risks. So you are setting out an investment thesis for listed blockchain equities in the work that we've published. What could derail this in the next 2 or 3 years in your mind?
Yes, firstly, of course, many of the themes we've just discussed are still relatively early stage,
Yeah,
right? So when we talk about DeFi as a potential contender to the global financial system, it may sound overblown at this stage a little bit. The asset tokenization theme, I think, is very much real and gathering pace, but we are still a long way from having a large part or a significant part of real world assets
yeah,
hosted on the blockchain. Um, of course, it's a high tech space, so technological innovation can also have an impact on the success of individual blockchains and companies building on those blockchains, right? So having in some instances, maybe having a more blockchain agnostic approach may shield some of the companies from the risks
yeah,
associated with the competition, right? Ethereum is of course currently the number one smart contract enabled blockchain, but it doesn't mean that it will stay that way always. You've got Solana, which is probably most suitable for high frequency trading and similar applications because of lower fees. You've got applications built on top of Ethereum, which are kind of uh, receiving a fair share of the overall fees generating on the network.
hmm
Ethereum is undergoing upgrades on a regular basis. They may fail, although so far the track record has been quite impressive actually in terms of implementing upgrades to the system.
yeah,
Um, Now, of course, what we've discussed, threat from traditional institutions. If you invest in a pure play native company, it doesn't mean that the incumbents will just sit there and do nothing, right? So they may face fierce competition from traditional players. Um, while you have a number of large cap companies in the space, there are also a fair share of smaller companies which are maybe at an earlier stage of development, they are early
Hmm.
revenue,
Hmm.
maybe even pre-revenue. Regulations are favorable now, but it can, always
Change.
change, go
Yeah.
south, and you can always have a black swan event like the FTX blow up in 2022, for instance, right?
Yeah.
Um, uh, and then we talked about the exposure of Bitcoin miners to the HPC/AI theme, right? So if you see a boom and bust, it may also affect them,
The,
right?
yeah. Okay, let's get on to some questions, and thank you for fielding them. Question one is observe that US-based wealth managers are publishing asset allocations. So, 10% Bitcoin, 60% equities, 30% gold. Um, is this something that we expect to see for UK-based wealth managers? How mainstream is it in the UK? What's your sense of that?
Well, that's a good question. I think the regulatory environment, right, in the UK was not that crypto friendly for quite a while, right? So the regulator was kind of restrained in this respect. So it's worth noting. I mean, I wouldn't point to any particular allocations, right? If 10% of Bitcoin is the right way to look at it. Um, I would probably say that what's important is that every investor needs to ask him or herself the question of what kind of volatility within the portfolio
Yeah,
can investor accept, right? Some will say, okay, 2% exposure to digital assets is fine. Some will say 5, some will say 10%, right?
yeah.
So it really depends on the risk appetite. Digital assets proved to be a quite nice diversifier in the past. But of course, they're a volatile asset class, so we need to keep that in mind. And I think that wealth managers like across the globe would be mindful of the fact and will be still cautious in terms of recommending those assets to their customers.
Hmm.
Um, and will probably focus on the more proficient uh, customers in this respect,
Okay.
right? And we'll try to be quite cautious in terms of recommending a large allocation to crypto assets, right?
Yeah. Okay. The proof of work type scheme and the idea that efficiency, either power or compute, if that's true, if you see a revolution in compute, so quantum computing, or a revolution on the power side, so some way away, but I think, but the concept of fusion suddenly lowering prices dramatically on energy prices. Um, Does that lead to a disruption and a price collapse, or is there some other mechanism that ensures there's always the amount of work that always requires to? I think you alluded to the fact that actually every year you need to put in more work effectively to earn the same.
Yes, I mean, of course, the quantum debate and the impact on proof of work blockchains has been going on for quite a while, of course. And the question
Yeah,
is whether quantum computing will break the SHA to 256 cryptographic algorithm of Bitcoin,
yeah,
right? Of course, it's difficult to go to this stage. I think my personal impression is that probably the risk may be a bit overblown. We need to remember that the that 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 the underlying tech stack of blockchains are not set in stone. You have a number of developers working on introducing improvements. And they are all aware of the risk from quantum computing. So
yeah,
I would say that it's of course a low probability, potentially low probability, but still a tail risk, of course.
yeah,
Um, from what I understand, it may be a more likely outcome may be, the risk in certain instances where keys are being reused. Basically, for some of the older wallets. I'm not an expert in this area, so I won't pretend that I have the right answer. But well, this is basically how I look at it, right?
yeah.
And
Okay.
at least from what I've heard, the additional computation efficiencies from quantum computing are not so large for in case of the Bitcoin blockchain as some may assume, right? And I think we'll have greater problems than that across other areas in terms of cryptography than
Yeah, yeah.
than the Bitcoin network.
Security,
But
full
yeah.
stop. Yeah. Okay. A final question because we're coming up to time. So, um, the motivation for government controlled stablecoins is thought to be taxation, but the government will be able to adopt very flexible schemes of taxation of assets and transactions. How far away might we be in a time where that kind of disruption to oldies like certainly me, who have assets but who are who are currently difficult for governments to tax, basically. So does this change effectively the way that the tax base effectively for the government?
Um, yeah, so I think the question is related to CBDCs, so central bank digital currencies,
Yeah,
rather than stablecoins
stablecoin.
issued by private providers, right?
Yeah,
From what I understand. And well, yes, if you basically have money on the blockchain, right? Especially on a private blockchain, let's put it that way. But well, not necessarily, because if you issue a CBDC and you control the smart contract, then basically you can automatically enforce taxation, right?
yeah,
Basically on assets. Um, I don't want to say that this is the government, this is the main motivation of governments, because we also need to keep in mind that some governments want to progress the digitalization agenda, want to make the currency more relevant, and
yeah,
especially when you look at emerging markets. I think the main reason for introducing CBDCs is more about the broader digitalization agenda
yeah.
to improve the efficiency of uh, of how the countries run and all the services, I would imagine. But it's just my personal opinion.
Okay. Milos, thank you very much. I mean, we're coming up to time. Might bring Mike back in. I appreciate that this is somewhat different to the sort of normal subject matter we tackle, but it is a sort of new area. So hopefully
Yeah,
we've given
yeah.
you some food for thought.
Well, it's a hell of a lot more complicated than thinking about it's thinking about investing in Shell or something,
Yeah,
That's for sure. Well, yeah, that was a hell of a journey through very quickly a whole world I'm not familiar with at all. So I'm going to go down and lie in a dark room at the moment and just kind of absorb all of that. But the reports, I had a look at a couple of them that you put on the website, and obviously for anybody who's completely baffled by what they've just listened to, I'd say go away and read those at your leisure, or come back and watch the recording and think about it in chunks, because it is a lot to get your head around,
yeah,
definitely. And But it's one I'd like to know more about anyway, because I think it's worth getting ourselves up to speed with this thing, because I've got a funny feeling this is how a lot of commerce and industry is going to be operating 10 or 15 years from now. And I don't want to be somebody who doesn't understand it all, the old bloke in the corner that where everybody ignores. Yeah, I think it's one of those kind of learning curves we've probably all got to go up at this
yeah.
stage.
No, no, no. I will make a comment, but Mike, that when we've been looking at the sort of digital asset space. They don't talk about it a lot, but some very large companies, places like Microsoft, have quite advanced thinking in this sort of area. It's just not the kind of thing that they sort of publicized regularly. So, I do think you're probably right that it is a play, it's a space to keep an eye on because some serious companies are taking a look at it and developing,
Yeah, yeah.
developing blockchain sort of technologies
Well,
around it.
yeah, yeah, there are. I mean, well, Charlie Nunn, the CEO of Lloyd's Banking Group, was getting
Yeah,
very excited about it the other day in one of his speeches, saying this is
yeah,
the way that we're all going to buy and sell houses in the
yeah,
future. Tokenization just disintermediates the whole thing and makes it much more secure in terms of buying and selling houses. So I must say, he obviously understands tokenization better than I do at this stage.
yeah,
But if Lloyd's Bank is getting excited about it,
yeah,
then yeah, I really ought to be listening a bit harder about this whole thing, and I think we all should ultimately.
Yes,
So
absolutely. Yeah,
yeah,
I mean,
so
I'm again talking about more maybe Robinhood, eToro, and the likes of them, but also large banks are exploring tokenization. JP Morgan and others are running pilot projects in terms of tokenized deposits and so on. So yes, it seems to be
yeah,
the way
yeah.
forward.
Well, I guess it becomes more and more credible and stable as more and more transactions, real world transactions, take place on
Yeah,
blockchain. And that
yeah,
is the way it seems to be happening. It's just my simple head says, well, if everybody's going to be buying and selling more and more stuff through a blockchain process, then, that's ultimately going to be the way that economies start to operate.
yeah. Let's see how it goes.
So
Look,
yeah, well, let's all get with the program.
yeah,
Anyway, thanks very much, Milos and Neil, for that. That was a very good session. Everybody got a flavor for it. I think we're all going to go away and do some more research. This
yeah,
is one
yeah,
where you definitely need more research.
yeah, absolutely.
Okay, guys, thanks very much and have a
Thanks,
good evening.
everyone.